Good morning, everyone, and welcome to this very special webinar where we are delighted to be joined by the Colliers team to share with you our latest West End retail turnover forecast. As you may remember, we released our first recovery turnover forecast back in February of this year, where we forecast the district to return to pre-pandemic levels of turnover of 10 billion by 2025. Of course, I think no one could have predicted just how turbulent the following months would become. The war in Ukraine, the energy crisis, the cost of living crisis, a new government, and more recently, a somewhat controversial fiscal statement from the Chancellor have all created a perfect storm of uncertainty. With this in mind, we thought it prudent to re-evaluate our forecast to give a more up-to-date and realistic picture of what to expect over the next few years. As these last few years have taught us, forecasting is an ever-changing model. Even since the report was finalised a few weeks ago, we have seen both good news and bad. We have seen the reintroduction of tax-free shopping, which is a huge win for the West End, but we have also seen the pound plummet to its lowest value, which will only exacerbate the domestic cost of living crisis and in turn consumer confidence. We cannot, of course, anticipate every change. However, we hope that this update, which also includes exclusive insights from TfL on the Elizabeth line, will prove insightful and useful. There will be an opportunity to ask questions at the end of the session, so please do feel free to enter any burning questions you have into the chat box on the screen as we go through. So now I'm delighted to hand over to Paddy Gamble, Head of Retail Strategy and Analytics at Colliers, to take you through the key trends and wider report in more detail. Over to you, Paddy.
Thank you, Dee. Yeah, as Dee says, really, I'm taking you through two pieces of work, really. So the combined outputs of the West End turnover report that Dee referred to, that is essentially an update of a piece of work that we did earlier in the year. It revisits a lot of the data points that went into that, so to give a view on sort of where we are year to date in terms of performance and how might a range of updated trading dynamics or indicators impact those forecasts that we produced at the start of the year. And then our Elizabeth line study, understandably very closely linked to the turnover work or model that we have developed, but really focusing on the Elizabeth line element of performance or potential Elizabeth line influence performance in more detail. So if we could just skip to the data slide. So sorry, we just jump to the next one. So thank you. So yeah, hopefully most of you on the call may be familiar with the previous report that was launched earlier this year, and that was essentially a very data-led piece of work. So it was underpinned by the various data inputs that you can see on screen, for example. So things like MasterCard transactions, mobility data as a proxy for footfall, understanding of volume of tourism or tourism projections, and so on. So I won't go through each of them in detail, but essentially this sort of mid-year update utilises the same key data points. We've been able to look at, for example, the most up-to-date merchant category level MasterCard data to inform our view on year-to-date performance by trading zone across the West End, or how this might differ by domestic or international card holder. So if we jump to the next slide, please. Alongside this updated data used for our turnover forecasts, our Elizabeth line study also utilises the latest TfL West End station passenger forecasts that Dee sort of referenced, which were TfL released in March of this year. So these really go into detail on passenger growth, but also forecast changes in line or station usage. For example, the movement from the Central line to the Elizabeth line, and what that might mean in terms of passengers now using Tottenham Court Road when, for example, they may have used Oxford Circus. We at Colliers, as part of the Elizabeth line study, also carried out quite a significant survey of West End visitors and wider London residents. So when I say significant, there were several thousand sort of consumer conversations carried out around sort of May and June of this year. So timed so that it was post-opening of the first phase of the Elizabeth line, which then gave us the opportunity to understand, first early adoption, and then actually how this might translate through to changes in behaviour or travel patterns or propensity to travel into the West End. Next slide, please. So first, we will start with the West End turnover work, and if we start by looking at West End performance up until around sort of the middle of this year. So what you can see on the chart we're looking at is footfall, the dark blue bars, and consumer expenditure, the light blue line. What you'll see is, and this is a very similar slide to, or an extension of the slide that we presented at the earlier this year, is what you see is that retail spend has continued to outperform footfall as we've moved through 2022. The footfall bars are sort of bumping along frustratingly, sort of with limited growth, whilst the sales indicator is actually continuing to grow. So that dynamic between footfall, sales and ATV, which we saw at the early part of the sort of COVID recovery, is continuing and suggesting to, or indicating that we are still continuing to see significantly increased conversion rates when consumers come in to visit the West End, or when consumers come in to visit the West End, they've got an increased propensity to spend. So, you know, it's a consistent message that I'll quite often give, but you need to look at, you know, multiple indicators to really get a view on that underlying performance. Don't just look at footfall, don't just look at sales. It's the dynamic between the two, particularly in a world where consumer behaviour is evolving. So if we go to the next slide, please. If we then start to first drill into the footfall element in a bit more detail. So again, on this slide, we see domestic footfall, the dark blue line, and international, the lighter blue line. And domestic footfall, which largely drove the footfall pattern that you saw on the previous slide, the growth, whilst there's still some growth, the growth has slowed during 2022 and sort of remained around sort of that 20 to 30% below. There will be exceptions for certain trading areas or certain sort of trading days and so on, but it's sort of hovering around sort of that 20% below 2019 footfall. Whereas actually when we are able to, through the mobility data, isolate the international element of footfall, actually we've seen, you know, quite a significant increase, particularly in recent months. So a real positive in terms of the international element of footfall across the West End. If we now jump to the next slide, please. And now, if we look at actually move beyond footfall and start to look at so the MasterCard data in a bit more detail and look at well how are those visitors were or are spending. So again, when we were sat here sort of at the start of the year, we were talking about increased ATVs or average transaction values for most customers. Actually, those increased domestic ATVs seen during the sort of early periods of 2021 and through those sort of periods of recovery have actually started to recede slightly and now sit slightly below sort of pre-pandemic levels. So again, you know, perhaps an indicator of, you know, some of the headwinds or challenges for consumers in terms of the cost of living starting to bite, and actually those ATVs sitting slightly below pre-pandemic levels. However, and again, you know, it's a positive indicator for international. So international ATVs have actually sat above pre-pandemic levels for the past 12 months and continue to sit above pre-pandemic levels. That coupled with the increasing rate of footfall recovery for that segment has really helped to sort of drive performance and recovery sort of particularly for this year or year to date. If we just jump to the next slide, please. And now, if we look at sort of blending those together and sort of start to look at sort of performance by trading location or zone, and what you'll see is that generally performance was below 2019 levels for the early part of 2022. You know, it's quite easy to forget that actually, you know, the early start of the year we were still being impacted by the likes of the Omicron wave and so on, and actually the start of the year it did start off quite challenging, and then since May we've actually seen performance broadly in line or above 2019 for most areas. So again, there'll always be some exceptions. So really, if you were to summarize the first half of the year or the year to date, you know, it's very much, you know, you would summarize it as challenging start followed by stronger performance. And as Dee sort of indicated in her intro, as we go into the second part of the year, it is going to be, potentially more challenging, certainly than the summer months where we saw, pretty strong performance across most areas, which means actually the outlook for the remainder of the year, we may land somewhere between Q1 and Q2 levels of performance. So we just jump to the next slide, please. So really sort of to summarize 2022 before we start sort of revisiting some of the more forward-looking data that extrapolates out the forecast for the next 10 years. It's 2022 spend continues to outperform footfall year to date. That dynamic between footfall, sales and ATV suggesting increased conversion rates or increased propensity to spend when consumers visit the West End. Monthly performance in line or above pre-pandemic levels for most trading areas since May of this year onwards. Regent Street has actually been the strongest performer, with weakest performance seen in Mayfair, where performance is yet to consistently hit pre-pandemic levels. Again, what does this mean? It means an increase of 109% versus the same trading period in 2021. It would equate to a annualized sales forecast for 2022 of around 7.7 billion. That's around sort of 15% below 2019 levels. However, the forecast for the remainder of 2022 has been revised down, or the annualized forecast has been revised down when compared to the forecast that we shared with you at the start of the year, largely as a result of the economic impact of a lot of the issues that Dee summarised at the intro. So again, I'll come on to those in a bit more detail, but that 7.7 figure revised down slightly versus the numbers that we shared with you at the start of the year. If we jump to the next slide, please. So now let's look to the future in a bit more detail. And so our approach at Colliers in terms of sort of understanding current or future West End performance is very much sort of built up around understanding some of the key drivers of performance that when combined equal West End performance. So you can see some of those drivers on the screen, and our data linked to these performance drivers is, we continually measure them, but for this piece of work have been updated and essentially reflect sort of the latest consumer dynamics or market conditions. You'll see that we've essentially traffic lighted the data points or drivers. Red is sort of weaker performance or a downgrade versus the iteration of this work that we produced earlier in the year, whilst green is a more positive outlook for that sort of driver or piece of data. So the first thing you'll notice is that there isn't much green. So the outlook, it is more challenged than when we produced our previous forecasts. And if I maybe sort of just to touch on some of these or go through some of these. So the economy. So it's a mixed bag. It's red into amber, and this is largely due to red is a reduction in sort of our forecasts for 22 and 23. London GDP is forecast to not grow at a rate at which we anticipated at the start of the year, understandably due to the broader economic impact, the war in the Ukraine, the knock-on effect on cost of living and so on has led to a downgrading of growth for London. However, there is an amber half to that sort of driver, in that actually we're forecasting out to 2031, and actually there is a rate of recovery, and when you look at the 2031 numbers, actually it's marginal change, and there's only a slight decrease versus where we expected to be in 2031 when we looked at or forecast that at the start of the year. Tourism, you'll see this as green, sort of touched on the positive performance of international visitors. Whilst the international visitor numbers continue to sort of forecast to hit pre-pandemic levels by 2031, actually the rate of recovery and the volume of visitors has actually sort of outperformed expectations. And whilst the pre-pandemic levels still are expected to hit the 2019 levels by 2023. Actually, by 2030, we're anticipating that actually that faster rate of growth will continue, which means that actually we were anticipating more visitors beyond that point than we were at the start of the year. So international visitors are actually pretty positive. Elizabeth Line, again, obviously going into a lot of detail in the slides coming up, so we'll sort of largely skip over that. You may wonder, why is it amber? That's not because we haven't seen a positive impact. It's because actually the impact is broadly in line with what we were largely expecting when we produced a piece of work sort of earlier in the year. The forecasts have been revised, and we'll go through these in a lot more detail. Again, the likes of population growth, again, largely unchanged versus sort of 6 months ago. And then sort of finally, in terms of the other red indicator is expenditure. So unsurprisingly, we have downgraded our forecasts in terms of consumer expenditure. We're actually anticipating sort of a negative impact or a reduction in consumer expenditure to sort of this year and next. So 1 to 2% reduction in expenditure forecast for 2022 versus actually growth when we were sat here earlier this year. And our 23 forecast has been downgraded. We are anticipating some growth, around 1%. Actually, that was previously around 4%. But again, longer term, that there is that speed of recovery beyond 2023 where there's the bounce back, and actually again by 2031 we're not too far away from where we anticipated we would be at the start of the year. And then again, finally, I'll jump over the likes of online impact. It's a mid-year update. We haven't seen huge swings in the 6 month period, so again, our views on sort of channel shift have not changed versus 6 months ago. So if we just jump to the next slide, please. So what does all this mean in terms of our updated forecast for the West End? A key focus of the previous report was sort of that 10 billion target for the West End, and actually, despite some of the changes for 23 and 24, 22 and 23, actually we remain on track to exceed that by 2024. Some of the numbers may have changed slightly, but actually it's the year at which we exceed the 10 billion target has not actually changed. However, as I touched on the previous slide, the forecast for 23 and 24, 22 and 23 have been downgraded versus what we shared with you earlier in the year. Previous forecast for 2022 was sort of around 8.4 billion, revised down to around sort of 7.7 billion. Previous forecast for 23 was around 9.4 billion, revised down to 9.33 billion. Next slide, please. So now let's look at the Elizabeth Line in more detail. So as we said, sort of our analysis utilises the TfL West End Station passenger forecasts that were released in March this year. And as I said, these really go into detail on passenger growth, but also changes in sort of line or station usage. These passenger forecasts have essentially been blended with the turnover model that we've built at Colliers. So and that blending and combining of the two sort of models or data inputs has really allowed us to forecast, but also isolate the impact that the Elizabeth Line is likely to have on West End performance. As I go through some of the numbers and some of the forecasts, what you'll see is that the TfL work, the forecasts were very much built around sort of the phased opening of the Elizabeth Line. So, I might refer to some of those stages as we go through the slides, and you can sort of see the stages on screen. So, the launch of the Elizabeth Line between Paddington and Abbey Wood, then the integration of the line services from east to west, moving through to actually not until next year that we actually see the Elizabeth Line being fully complete, fully open, and the trains running end to end. And it's really at that point that you start to see a ramp up in the benefits, particularly things like the journey times and so on. It's at that point that you start to get the full benefit and the full knock-on impact for the West End as a result of the Elizabeth Line opening. So if we jump to the next slide, please. And sort of as I've said, we are really looking to understand sort of the net positive impact of the Elizabeth line. So our analysis has largely focused on the figures on the left-hand side of this slide that essentially sort of strip out things like the underlying population and growth, so that we can really understand the net impact of the Elizabeth line. And at a high level, what is this showing? So a 13% net increase in entries and exits for West End stations between now and the delivery of what TfL call sort of stage 5C. So as a reminder, 5C is that point in time where the Elizabeth line is fully complete, fully open, and the trains running end to end, the likes of Bond Street open and so on. And that 13% net increase, that's a net figure for the combined West End stations. And actually, if you look at the likes of Bond Street, for example, that's a 30% net increase. Tottenham Court Road, that's a 50% net increase. So significant growth in entries and exits, which will translate to above ground footfall and movements of people as they exit or enter those stations. So some quite significant numbers, particularly when you localize sort of specific stations. And then moving sort of beyond to the future, the TfL work was projecting all the way out to 2041, and actually that 13% net increase is equal to a 44% increase versus today for the West End, once you factor in things like the impact of population growth and so on. So if we jump to the next slide, please, and start to sort of look at those numbers in a bit more detail and sort of the drivers behind some of those numbers. And so whilst we are talking about overall that 13% net increase in entries and exits at West End stations once the line's fully complete and open, actually TfL are estimating that the vast majority of Elizabeth line passengers will switch from other routes, with the main transfers being, for example, from the Central line, the Jubilee line, the DLR and so on. And a result of that is that actually some stations are forecast to have a decline in overall entries and exits as a result of the Elizabeth line. For example, Oxford Circus forecast to see an 11% net reduction in entries and exits. Marble Arch, a net reduction of around sort of 3%. And firstly, we shouldn't necessarily see those as negatives, that we're going to get fewer passengers exiting Oxford Circus, the knock-on effect on footfall and so on. Actually, that may drive an improved customer journey, an improved experience in the West End and so on, as a result of less overcrowding at peak times and so on. So it's about not just getting more people into the West End, actually it's about improving the customer journey and experience of people in the West End. And also it's worth noting, and again I'll come onto this in a bit more detail, that this movement of passenger journey from one station to another will impact above ground footfall flows as actually these passengers continue onto their destination above ground, which would have previously been served by another station. So actually the footfall is about changes in movement, not necessarily moving from one or disappearing from one part of the West End to another. Ultimately their final destination probably has remained the same. If we jump to the next slide, please. So now if we start to look at some of our sort of post-opening sort of consumer sort of conversations or surveys in a bit more detail, and these highlighted that already around 13% of visitors are already using the line as a main mode of transport into the West End. However, if you sort of look into this or isolate this 13% in a bit more detail, for example, we look at their home location. This sort of started to provide us with insights or an understanding of the area of influence for the Elizabeth line, or a catchment area for the Elizabeth line, with around 75% of those using the service actually located around sort of 2 miles from an Elizabeth line station. And if we just jump to the next slide, please. Because this then in turn allows us to really quantify the resident population that is likely to be positively impacted by the introduction of the Elizabeth line. So a population of around sort of 6.8 million residents. So really highlighting the scale and influence of the number of London residents that will benefit from that improved access and improved journey times into the West End. So Elizabeth line equals improved accessibility and improving quality of journey for around 6.8 million London residents. If we jump to the next slide, please. Obviously, the full benefits of the line are not yet being realised. The full end-to-end running of the trains will deliver the fully reduced journey times, and the likes of Bond Street station, for example, is not yet open. So we also sort of discussed sort of intended use. So around 80% of the consumers or the West End visitors or wider London residents that we spoke to expect to have some sort of interaction with the Elizabeth line. You know, that coupled with, you know, within that, those 13% that are already frequently using it. And when you look at things like the strongest current or anticipated users, you know, unsurprisingly, it's largely driven by those within that sort of 2-mile radius, or those living in close proximity to the stations. It is those more frequent West End visitors. It is highest amongst those that are, you know, weekly visitors, those visiting 2 to 3 times a week, and those sort of working in the West End. So if we just jump to the next slide, and if we look at sort of from adoption and start to look at potential changes in behaviours or propensity to interact with the West End. So clearly the Elizabeth line will impact a significant amount of West End visitors, and around 46% of those visitors or wider London residents indicating some sort of positive change. You know, positive change sort of being, you know, whether that will be travelling into work more often, exploring, or spending more money in the West End. And then, you know, if you probe those positive changes or impact in more detail and drill into what categories are likely to benefit, actually retail was indicated to be the biggest beneficiary, followed by F&B, and then cultural activities. If we now move to the next slide, please. So COVID obviously disrupted consumer and worker behaviours and has potentially altered some of those behaviours for the long term. But actually, if we drilled into the data, you know, and we looked, and it highlighted that, you know, we have typically seen visit frequencies decline, particularly for workers that may have previously been in 5 times a week and are now 2 or 3 times a week. And actually, when we looked at the data, and what was interesting is that actually we could see that, you know, Elizabeth line users, or those that anticipated using the Elizabeth line, actually there were some clues within the data that highlighted that it could push some visitors towards sort of pre-pandemic levels of behaviour, or reverse some of the negative impact on things like visit frequency. And, you know, we isolated those that had shifted from daily visits to 2 to 3 times a week or weekly. You know, huge chunk of those were workers. And actually what we saw is that the Elizabeth line is likely to have, or they had indicated that the Elizabeth line is likely to have a significantly above average propensity to have a positive impact on their behaviour, particularly related to things like travelling to work. So, you know, perhaps that beneficial impact the Elizabeth line brings in terms of quality or speed of commute will actually push, you know, a worker back an additional day per week and move them from 3 days to 4 days, or 2 days to 3 days. So, you know, some of the barriers or negative influences in terms of commuting, actually the Elizabeth line improves some of those and could potentially reverse some of those negative impacts that we've seen as a result of the pandemic. Next slide, please. So now, if we start to look at some of sort of the localized impact for the West End. So, you know, when we talk about travel patterns and we talk about origin to destination, actually what's the impact on destination? So first, actually, you know, if we look at actually for most people, you know, what drives their travel pattern. So for most people, shortest journey times and proximity to destination dictates your travel pattern. You have a destination in mind, or you have a destination that you need to get to. You look for the closest arrival point, and that will most likely dictate your route. But actually, you know, you may look for alternatives if there is a quicker route, or a route that gives you a more direct route, or fewer line changes. So clearly the Elizabeth line has given those 6.8 million London residents an alternative route. In most instances, a shorter journey time, and then probably also a more direct route into the West End. And when we look at those already using the line, actually around 56% of them have moved from their normal arrival station. So, you know, their destination hadn't changed, but the station at which they had arrived at had changed. That will have a knock-on impact on the above ground movements of people and flows of sort of footfall post exit or entry of the station. So if we jump to the next slide, please. So what does that equation sort of between sort of shortest journey time and proximity to destination actually mean? It means that, for example, everyone that exits Bond Street or Oxford Circus Station is using that station most likely as a result of their onward journey to the destination. And, you know, this all sounds sort of really obvious. I'm probably sort of communicating to you how you move and decide how you use a certain tube route or get to work, but actually the point I'm trying to make and what it actually means is that, you know, each and every tube station serves a unique but overlapping catchment that dictates above ground flows of people and footfall. And so if we just move to the next slide, please. And it's these station level catchments and consumer movements that will ultimately be impacted by the Elizabeth line. The main report, which you know is available sort of from today or later today for members, is available on the NWEC website. The report will go into some of these elements in a bit more detail and a bit more granularity in terms of some of the key trading zones and stations in a bit more detail, but what you can see on screen is the areas most impacted. So impact on this visual can either be positive or negative. It's essentially indicating change. So that change could be increase and decrease in volume. It could be in change of flow or direction of movement. But essentially, it's impacting the areas that will be most impacted by the opening of the Elizabeth line. So if we maybe step through a scenario, so you know, Oxford Street East will benefit from significant uplift as a result of passengers using the Elizabeth line at Tottenham Court Road. The station's forecast to see a 50% net increase in entries and exits, which will be, you know, in some part driven by passengers switching from the Oxford Circus services. Oxford Circus forecast to see, you know, 11% net reduction in entries and exit. This below ground passenger movement is likely to result in, you know, footfalls flowing back towards, you know, the likes of Oxford Circus or areas between Oxford Circus or Tottenham Court Road and the north and south of those areas, i.e. the passenger destinations have not necessarily changed, but the route has, and as a result, that passenger equation between journey time and proximity to destination is essentially having an impact above ground and movements and flows of consumers across the West End. If we jump to the next slide, please. So as I said, a lot of that sort of granularity in terms of the passenger movements and flows of consumer at a localized area sort of is in the report. But if we now move through to actually how does this all sort of translate through to performance? So as we said, we've combined our West End turnover model with the TfL passenger forecasts, plus those insights gathered around sort of likely changes to customer journeys and propensity to visit or spend in the West End. This has allowed us to run essentially almost like a with and without Elizabeth line scenario within that turnover work that we presented at the start of the presentation. And actually what you can see is the Elizabeth line forecast to boost West End performance by around sort of 7% versus the non-Elizabeth line scenario by 2031. So that positive impact, you know, firstly felt on a sort of annualized basis. You see that sort of growth up to around sort of 2025, and then sort of essentially sort of plateauing out beyond that 2025 period, when you know you get that full end-to-end running of the line and the full benefit being felt within those TfL forecasts. So if we now jump to the next slide. And if we sort of finally look at the turnover forecast in more detail, and actually we put sort of a range of forecasts there. So, you know, that 7% uplift, very much sort of the average uplift that they would expect, you know, equates to around by 2031. That, you know, when you look at that in monetary sort of values, around 700 to 800 million pounds in additional sales had the Elizabeth line not been present by 2031. And actually, when you look at that on a cumulative basis, so actually, you know, you take the benefit in 22, 23, 24, you add all that up, and actually, you know, between now and 2031, you know, you're talking about a cumulative benefit of around 5 to 7 billion. And to put that into context and relate it back to the turnover work at the start of the presentation, you know, 7 billion is not far off what we're actually forecasting for, you know, the wider West End, or the core West End retail forecast for 2022. So, you know, that's almost like giving the West End back. You know, a lot of the sales that were lost during the period of sort of COVID impact, it's almost like an extra year's trade between now and 2031 had the Elizabeth line not been implemented. So, you know, a real boost in performance and positive impact for the West End. So the next slide does say thank you, and I think we move through to a Q&A.
Paddy, thank you for that incredibly well thought out updated forecast. I have got a couple of questions. Please do put them in the chat box if you can, everyone. So Paddy, first question is, are the longer term revenue forecasts inflation adjusted?
No, they don't take into account inflation. So it's you know, I'm presenting to you a 2022 view. So they account for the likes of population growth and, you know, increasing, decreasing ATV and so on, but it doesn't have inflation.
Thanks, Paddy. Wondering if sales forecasts include leisure spend, coffee shops, bars, cinemas, etc.
Yeah, I love that question. It gets back to, I talk about retail. Retail in my mind is very much sort of a very broad category. So it includes, you know, the likes of food service, restaurants, and so on. So it's retail in its broadest sense. It excludes things like sort of hotel categories and so on, but it includes what I would define as the very broadest sense of retail.
Thank you, Paddy. Given the cost of living crisis, how can we expect Christmas to look? Are you still forecasting a lift in sales in the eighth week Christmas trading period?
Yeah, and this sort of gets back to these. We quite often joke as soon as I create a forecast that we something happens, which almost straight away I get a challenging question. I mean, clearly there's downgrade built into the forecasts. So, you know, where we were at the start of the year, you know, we were predicting growth, and I think the Christmas period will be more challenging. You know, the consumer confidence has been impacted, and you know, Christmas, if you were asking me that question versus the forecast that we produced at the start of the year, yeah, it's probably not going to be as positive. If you ask me, you know, versus last Christmas, for example, you know, I think it will be more positive. That, you know, there's things that drive the performance, and actually, you know, we quite quickly moved on from the likes of, and I referenced it at the start of the presentation, you know, the Omicron impact, and, you know, I think footfall will be better, you know, understandably. I think, you know, footfall isn't going to be impacted by, you know, some of the broader economic impact that we're seeing, but the consumer is probably going to be more conscious on their expenditure and so on, and, you know, that may impact certain categories more than others, but certainly I still anticipate, or we would anticipate, you know, Christmas to provide a boost for the West End, but it's probably less of a boost than had we not been facing some of the headwinds that we're currently seeing sort of pan out. So yeah, it's going to be more challenging, but certainly versus last year, better.
Thanks, Paddy. Is this forecasting based on a continuation of the new normal in working days and commuting patterns being less per week?
Yes and no. So again, I think I like to sort of build around scenarios. So I think I didn't go into too much detail on the scenarios, but this is very much built around what I would call our midpoint scenario. So there'll be a slightly more positive view to this forecast and a slightly more negative, but essentially the worst case scenario that we will look at assumes that everyone will not go back to the office 5 days a week. Best case scenario, actually, it's, you know, on average people are sort of 4 to 5. This is where we land, somewhere in between. So it certainly is built in that the worker element. So when we talk around sort of footfall and drivers of performance, and you know what drives some of the numbers that we presented here, I largely focused on sort of domestic versus international. Actually, we break domestic into sort of wider London residents and workers. So understandably, a huge chunk of the performance is driven by, you know, high frequency visitors, the workers, and so on. And we do build in sort of flexible working. So we don't build in that, you know, they will all come back for 5 days a week. We do think some of that it will stick, and therefore they're built into the forecasts.
Thanks, Paddy. On that note, the uplift in retail spend, where is it leaking from? Where are we seeing the declines?
In terms of sort of categories or sort of I mean, there's various things in terms of so declines are driven by, I suppose, a squeeze on consumers. Actually, you know, the energy bills are impacting actually what they spend on retail. You know, food prices going up will impact what they spend on certain retail categories, or you know, we'll quite often talk about needs versus wants. And actually, you know, the wants based, the more unnecessary spending on certain product categories will get hit first. So, you know, the clothing, accessories, and so on. Actually, I won't buy a new jumper because, you know, I don't need it. It gets diverted to the more essential sort of spending. That will impact it. Plus, you know, there's also the online impact will impact it. So I think when we talk about changes in expenditure and how that tracks over time, there's various, you know, reference some of the drivers, that slide that I had the traffic lights on, you know, ultimately they will influence the end point is footfall or sales, and most of them are impacting sales. So whether it's, you know, economic challenges, changes in consumer behavior, or diversion of spend into other product categories. So it's hard to pick out one specific one. It's about, you know, the consumer and where they spend their money with.
Thanks, Paddy. We've got a few more questions coming in. I think there's one here on the slides, but I think you might have said in your presentation that the slides are available for all new Ascend company members through our website. Is that correct, Paddy?
Yeah. So I think, you know, anyone with the login to the insights element of the website, they'll be downloadable. Again, I think that's also the case for any sort of colleagues that have not been able to dial into the presentation. I think I have been recorded, which I always hate. That will be available for anyone to listen back and share with colleagues. But yeah, it's all on the new West End company website.
Paddy, I'm not sure if you covered this in the point around inflation before, but are the sales figures in real or nominal terms?
So they're at 2022 prices. So yeah. So if all of this was to happen today.
Yeah, thank you. Any thoughts regarding the growing use of bikes, e-bikes, scooters impacting on transport use? Oh,
that's a challenging one. I think that there will be. I mean, clear. You know, this isn't all my work. I mean, there's a lot of input here from TfL, and so whilst I've focused on their West End sort of station usage, clearly as part of, you know, they're projecting transport usage across the West End. So, you know, they'll have been included within those forecasts and accounted for, you know, more people using the bikes and so on, and will be therefore picked up in the forecasts. I think, yeah, I mean, they're all growing in popularity, and they're things that improve accessibility and movements of consumers. But I think had there been someone from TfL, I'd probably deferred that question to them in terms of the absolute growth and so on. But I know that they would have been accounted for in their passenger forecasts.
Thanks, Paddy. Is this analysis taking into consideration the return, or very hopeful return, of tax-free shopping in the UK?
I think this sort of jumps on sort of joke with Dee that I deliver something and then something happens that instantly says, well, what's the impact on your forecast? So the change in tax-free shopping came very late in the day on this piece of work, and so again, if you almost look at these are forecasts, and you need to look at a forecast as a range of what might happen. And I think probably the return of tax-free shopping is probably would give a slight bump in some of these numbers. I think when we talk around international visitors and the link to tax-free shopping, I think it won't necessarily massively impact someone's propensity to visit the West End or visit London. Actually, what it does is it might impact for certain number of those visitors their propensity to transact, or the amount that they transact. And I think the announcement last week is only going to have a positive impact on the tourism element of these numbers. So it might give a slight bump in the monetary value that international visitors spend, but I don't think it's seeing any material change in the rate of recovery and growth in volume of visitors.
Okay, we've got another probably 4 or 5 minutes for questions. If you have any more, please do get them in the chat box. Paddy, will all of the West End see a benefit from the Elizabeth line, or will it be more clustered around the new stations?
I think a bit of both. I mean, and that's why the work sort of went into that. I mean, at its top level, the West End has become more accessible for those 6.8 million people around the Elizabeth line. And going back to I talked around sort of the equation between sort of speed of journey and ease of getting to a location. For those 6.8 million residents, when they're sat at home, and for example, if we focus on retail, if it's on a Saturday afternoon and they're thinking about, where do I go to spend my money this afternoon? Actually, it could be the West End. It could be if you're a Southeast London resident in Woolwich, for example, it could also have been Bluewater. It could also have been somewhere else. And actually, for that resident, it's become so much more accessible to come into the West End. So I think, yeah, they may arrive at Bond Street, they may arrive at Tottenham Court Road, but they will have that end destination, which is somewhere in the West End, in mind. And I think ultimately the propensity for people to come in and the ease for people to come in will benefit the wider West End. Clearly, there will be some localized benefit in terms of the flows of footfall that have changed. So, if you take the worker population, their journey might change, and therefore a coffee shop from your route of arrival station to your office, that might change, and that might mean that actually the coffee shop that you pick your coffee up from on the way in, that might change. And so there might be some more localized benefit around some of those stations. But ultimately it's a long-winded way of saying both. There'll be localized winners, but I think overall the broader West End will also win in terms of that 13% net increase in all stations that serve the West End.
Thanks, Paddy. We've got one last question, so we're just in time there. It's just some clarification around the spend that's included within the reports, and as to whether hotels are included as part of the retail spend, as we call it, or not.
So the billions of figures that I mentioned on the slides and so on, so that's what I said, that very broad retail category. Hotel we do have as a separate category, so it's not within those numbers. So yeah, it would be on top of those.
Okay, thank you. Thank you, Paddy, very much for joining us and taking us through that very comprehensive report, and for all of you that joined and for all of those that asked questions. Any follow-up questions, please do feel free to send them through to Paddy or Alice today. And as we've said, the details for that and in fact the pack can be found on our website. Thank you again for joining us this morning, and we hope to welcome you at another New SN Company webinar very soon. Take care, bye-bye.